Okay, hello everybody. You're really, really welcome here to our live broadcast. And I'm so delighted to be joined by Nathan Dunne of Zurich and Kent Ashmore of Ashmore Financial Services. This talk is about auto enrolment and the impending speed of which is coming in for employers. As employers, this is a kind of a lastminute.com for people. This thing is actually happening. There's been a lot of talk over the last number of years about auto enrolment and exactly what it is. But in one way, it's another burden on employers to deal with. But it's going live, and I'll introduce you to the team in a minute. But I think it's going live from the 1st of January. And it is something that you can't avoid as an employer. So this is a really, really topical, and I'm delighted to have Nathan. So, Nathan, would you just like to introduce yourself to everybody, please?
Yeah, thanks very much, Paul. My name is Nathan Dunne, and I'm an account manager for Zurich Life for the southeast of Ireland. So I'm delighted to be here this morning.
Thank you. And Kent, would you like to introduce yourself? Even though we've had a few of these, but
Absolutely, yeah. Kent Ashmore, independent broker here based in Enniscorthy. 20 years open this year. A lot of experience in the whole pension scene. So there's a lot of confusion out there and I suppose nervousness really with employers. So it's great to be on this morning and with Nathan's expertise there as well. To hopefully dumb this down a little bit, but also there's some really, really key dates and things like that coming up. So I think it's really important for people to know that and they'll get that out today.
okay. So if it's okay with you, Nathan, I think we'll do this as a question and answers type of a scenario because I've got some questions I want to know myself, and I've got some questions in from people. So, and people, I just want to let everybody know we'll send a copy of this out to the people who are on our email list. It's also on YouTube, which you can get it. But we'll also attach a couple of links that Nathan will speak about in this as well, just to be more helpful for everybody. And I suppose on a very, very basic level, what is auto enrolment?
Yeah, so basically what Auto Enrolment is, it's a government-backed retirement savings scheme. It is mandatory. It'll be also known as My Future Fund. Auto Enrolment will impact roughly around 800,000 people in Ireland. And it'll be basically for anyone who's between the ages of 23 and 60. And as long as they're earning more than 20,000 a year, and if they're not already in a pension scheme that's facilitated through payroll, they'll be automatically enrolled in the auto enrolment pension scheme.
Okay, so just on that basis, ages between 23 and 60. So if you're a local hotel or something and you're taking in summer staff and part-time staff as well, it doesn't affect the part-time staff providing they're 23 and under 20k.
Correct. So as long as they're not between the ages of 23 and 60, and if they're on less than 20,000, they wouldn't be eligible for auto enrolment.
Okay, so I suppose the next question is, what are the contribution rates and how do the rates actually work?
Yeah, so the rates will be over a 10-year period. So initially, the rates in auto enrolment will start at 1.5% from the employee, 1.5% from the employer, and there will be a government top up initially of 0.5%. So the aim of auto enrolment over a 10-year period is to eventually get to 6% employee contribution, 6% employer contribution, and a 2% top up from the government. So contributions will be phased over a 10-year period with the aim to eventually get to 6 from the employee, 6 from the employer, and then 2% from the government. But they'll initially start in the first 3 years of 1.5, 1.5, and then 0.5 top up from the government.
So the 1.5 from the employee is tax deductible as a pension contribution, I assume, as the normal rates apply.
Well, I suppose if your question is in relation to tax relief for the employee, they're getting the top up from the government of 0.5.
Oh
So
yeah,
that
okay,
basically equates to that. So there's no, I suppose, tax relief as such when it comes to auto
yeah,
enrolment. It's the 0.5% uplift from the government is what they'll get
it's
for it,
giving you the
Yeah,
effective tax rate, which is
give or
30%
take.
based
It
on the
works
one
out
and a
at
half.
around 25%, give or take.
25%, okay. So it just, as an employer, it just feels like another tax, and I think it's a discussion and the 1.5% doesn't seem if you're an employee, it doesn't seem like enough of a contribution, but I do understand there's 800,000 people to come onto the scheme, and I think it's a way of getting people to think more about the benefits of having a pension. Would you agree?
Absolutely. Yeah, absolutely.
Yeah.
Yeah.
So we're looking at, so as we're looking at, sorry, Kent?
Sorry, Paul. Sorry, there was a delay there. Sorry. From a top-up perspective, then going forward, like 1.5% is, it's a start, and there's 800,000 people that are going to benefit from that. So the positives have to be taken from that. But from a pension funding perspective, then it is important that people maybe look at possibly topping that up as well. So
Yeah.
Nathan, from that perspective, then what have Zurich on offer there to allow people to do that?
Yeah, so I suppose if someone does go into auto enrollment, so again, as long as someone is in a pension scheme facilitated through payroll, they'll be exempt from auto enrollment. If someone is enrolled in the auto enrollment scheme and they are putting in 1.5% and their employer is putting in 1.5%, it would be possible for that individual to do what's called a PRSA. So if they wanted to top that up by an extra 2%, obviously the contribution rates in auto enrollment are very, very restrictive. So they would have an option to do what's called a PRSA in addition to that. Or they could come along and set up their own PRSA or a company pension that is facilitated through payroll in advance of auto enrollment being set up.
So just to be very clear for people here and to be very clear on the distinction, the auto enrolment that you're talking about is a government scheme, and it'll be operated through the payroll system as if it was PAYE deducted or PRSI deducted or whatever the deduction is. It's nothing to do with the likes of Zurich or Kent or independent companies. It's a government scheme that will be operated by the government that will determine. So in terms of the government at the other side of this, when you get to that, you've got your 10 years. So we're saying up to 6%. So it's not somebody that has 10 years service. The 1.5 starts the clock at year one, and then the contributions rise based on an annual basis, not based on years of service. Is that correct?
It's yeah, exactly. Yeah,
But
everybody will start at 1.5 and 1.5 from the get-go once they're eligible for AE. Yeah.
Not if you've 20 years service, it makes no difference.
It's from when auto enrolment starts on the 1st of January, correct? Yeah.
And I know this might seem a silly question, but so somebody gets in here and they're in for 20 years. What's the likely pension, like at the 1.5%? Who invests that? Is that a government, or what's the benefit on the other side of this? Like, how is it taken? Is it just an additional
that drawdown? Is that
yeah?
Is that the question?
Well, I mean, if we invest, if I go to a reputable broker, like say Kent, I do a pension scheme for the employees with Kent or with any other reputable broker. They go to somebody like Zurich. Kent is then responsible for helping the people with investment choices, with everything. The government scheme is not. You've no impact. You just put your money in, and the government deal with it. Like, is that correct?
Yeah, exactly. But there will be fund managers when it comes to auto enrolment. So there is 3 fund managers that have been appointed for auto enrolment. But in terms of the advice piece, there's just no advice when it comes to auto enrolment. As I said, it's strictly government. Contributions are invested, and there'll be a lump sum payable then at that individual's retirement age. And I suppose just to add to that point, there's no advice. And when it comes to auto enrolment, one of the main limitations of auto enrolment versus a private pension scheme, for example, is that auto enrolment cannot be accessed until an individual reaches state pension age. So at the moment, that's currently 66. Again, whether that goes higher in the next couple of years remains to be seen. Whereas with a private pension plan, it's actually minimum age 60. And if someone is in a company pension scheme, for example, and they left service, they could potentially access that benefit from 50. So that's very much a limitation when it comes to auto enrolment. Number one, there's no advice. There will be a default investment strategy. There is 3 fund managers, but the access is restricted to 66.
And with respect to the government and spending and investments, you'd have to say to yourself, this is not something you can control. Like, I can't control how much I'm going to get in my state pension. I've no control over it whatsoever. I go into auto enrolment, I've no control over what the return is going to be for myself on it, and I've no impact in it. So it's another version of the state pension that is given to me because I'm an employee. It tops up my state pension and whatever it is. So, but I've no control over that, and I've no control over the fund. So for me, as an employer, I can see two very, very distinct paths here available to employers and employees. One is the auto enrolment, and two is an employer based contribution. But I can also see a lot of issues with that, because I can see so you have a large volume of staff that are, I'd say, transient staff, and that's not the word I'm looking for, but staff that come in and they're short-term employees. They work for say a year in a place, and they're moving employments across the board. I think it would be very difficult for a government, for an employer scheme to do that. The auto enrolment would potentially suit, from an employer's perspective anyway, would suit that style of it, and would suit just the auto enrolment scheme. And then for somebody who's kind of long-term employees in a settled employment role, it seems to me a very obvious choice that you go to a reputable broker and you sit down and you actually start the process. So if somebody kicks this off with auto enrolment, can they change schemes from auto enrolment back to an employer scheme after?
So from an employee level, so there is going to be an opt-out period when it comes to auto enrolment. So employees will be able to opt out after 6 months in month 7 and month 8. So there will be an opt-out facility from the employee's perspective. But what will happen there is they'll be automatically re-enrolled in auto enrolment every 2 years. So they can opt out after 6 months, but if they don't join a pension scheme that's facilitated through payroll, for example, they'll be re-enrolled in auto enrolment every 2 years.
But an employer can't obviously opt out. They still have to continue with the 1.5%.
So when the employee opts out, the employer doesn't have to continue paying in if an employee opts out. But as long as an employee stays in auto enrolment, the employer will have to match the contribution.
Oh, so if an employee opts out, that gets rid of the 1.5%.
They don't have to continue.
That seems a little bit of an unusual scenario when you're putting employees into it, to give them the option of opting out. I mean, it doesn't make any sense to me personally. But then,
just that a little bit more. If an employee does opt out, they will get their refund back of their own contribution. The employer contribution stays invested in the auto enrolment scheme.
So technically on that then, Nathan, if an employee is in it for 6 years and then they decide to opt out, what you're saying then is they'll actually get their money back.
After the 6 month period, yeah, but I suppose if someone is in it for that length of time, Kent, we'd have to, it all depends on, what we know at the moment is they can opt out after 6 months. So they can opt out after 6 months, but if they're in it for a longer period of time, they're in, if that makes sense. So they've been in it for so long, it's probably a little bit different as opposed to just opting out after the first 6 months. So that's
because you have the 2 years. So if you opt out after 6 months, you have to be in a pension after 2 years. So you have to go back in.
Otherwise, you're automatically enrolled again.
Otherwise, you're automatically enrolled again. So your opt-out clause is after 6 months, but after 2 years, you're in. So you're in.
You're constantly,
You're constantly in, and it will follow your PPS number. So if somebody puts the money in after 6 months, they can opt out, but they're only opting out for a short period of time, and they're back in. But I wonder then if they come back in, do they start at the current level at that year, then do they start at say 3%, or do they go back to no one knows the answer to some of these questions because this is very new. So we're just kind of doing scenarios. But for me as an employee, my best, if I'm in structured employment, it's obvious for me that the company's pension scheme is the way to go. Whether as an employer, I have to facilitate that anyway. So, but my understanding is that if I don't have contributions up by November, I have to go into is that correct? Do I have to go into the auto enrolment if I haven't made a...
Yeah, so I suppose I might just reference recently there was a webinar done by the Department of Social Protection, and I'm happy to share the link with yourself, Paul, after today's session that can be shared with employers, because it was a webinar that was specifically tailored to employers where they were actually advertising what the portal is going to look like. So the way they've kind of phrased it really is that there will be what's called a 13-week look back when it comes to auto enrolment. So when the auto enrolment starts in January, they'll do what's called a 13-week look back to see basically who's eligible for auto enrolment. They'll be going into employers' payrolls, and they'll be able to see that. Now, my understanding is at the moment is that 13-week look back will end on the 13th of December. So basically, if an employer or employees are paid monthly, to safely avoid auto enrolment, the suggestion is that employer should be deducting for a company pension scheme, or even if it's a PRSA scheme, for example, in November's payroll, because the look back
so
period ends on the 13th of December. Correct.
So we're running out of time.
Yeah, exactly.
So,
That's
but then
based on that, yeah.
So if I refer back to my previous question, just from my own head, if I run out of time, I have to go into the auto enrolment, and after 6 months, I can move to a company. So the company can set up their own scheme in the first 6 months to bring employees in after 6 months if they want to leave the auto enrolment and come into an employment scheme. Is that correct?
Provided they want to opt out of auto enrolment, and provided they, yeah, exactly.
If they want to opt out of auto enrolment and continue in an employee scheme.
Exactly. Yeah, they can opt out and
okay.
then they can join an employer's pension scheme if that's what they want to do, you know.
So here's the really, sorry, Ken, go ahead. Go ahead.
Sorry, on that, a couple of queries there as well. Whereby, say you have an employer at the moment who has a certain amount of employees in a PRSA scheme, okay, but the rest of the team aren't. Like, can the employer run two schemes then, auto enrolment and their own private?
It is possible, yeah, because if there's a number of employees not currently in the pension scheme, come 1st of January, if they're not in a scheme, they are going to be enrolled anyway. So it's mandatory. As long as they meet those requirements, i.e. more than 20,000 between 23 and 60 and no pension going through payroll, they'll be enrolled anyway. So in theory, there would be a case where there's two schemes running side by side.
Okay, so now, as an employer, what do I need to do?
Yeah, so again, going back to the webinar, my understanding is that the portal will be ready for registration around December time. So what we understand is that all employers will have to register for this. They'll have to register for the portal and set up a payment method. They'll also have to inform employees of auto enrolment. So they will have to inform their employees. So that's two of the main things really that employers need to be aware of. Number one, they will have to register for this portal when it's ready. And number two, they will have to advise their employees that auto enrolment is coming, you know.
Okay, so I can see the payroll department, here. Sometime, possibly in December, it'll be registered. They'll have a heart attack. So, and then it'll be applied for jury through the. I'm just looking sideways here because I'm reading some of the questions that we have. So it's registered for the online portal, communicate, apply payroll notifications they receive from NAERSA.
NERSA. So that's the name of the agency, NERSA. Yeah.
Okay. So a couple of more questions. What if I already have a pension scheme in place? What do I need to do?
Once there's a pension scheme in place that's facilitated through payroll, they don't have to do anything. They'll be exempt.
You still have to register though, but you still have to register.
My understanding
this is a critical.
You still have to register. Yeah, and the reason being is that employers will still have to register, but once they're registered and NERSA have the ability to look back and they see deductions going out through payroll for employees, that will exempt the individual from auto enrolment. But my current understanding is even if you have a pension scheme in place, you still have to register for the portal. Correct.
And we haven't got any specific knowledge from the payroll providers, but I know assumption is not really one of the greatest things of all time. But I'm assuming that they will have as part of this, they will have this sorted out in terms of the payroll software to adopt to this. So I'd imagine it's being collected through the payroll software and informed to revenue through the payroll software as a normal course of a deduction and collected as the local or the taxes are usually collected. It's complicated and it's simple. I know that sounds a ridiculous statement. Like it's, register for your fund, inform your employees, make sure your you're dealing with it properly. But as an employer, I think you really need to consider this really seriously, and I think in the instance where it's best for the employee to that are structured, I would recommend that you talk to a broker. Obviously, Kent is on here on the call here, and his details would be here. And because I do believe that when you do it through that way, you're doing a proper service for you're completing a proper service for the employees. Not saying that the auto enrollment is not proper, but you need to be able to control your own money. You need to be able to control your own investments, and this is an opportunity that the government are giving you. And with respect to the government, they are, the employees are putting scheme in. The government are putting money in. It's tax-free money. They're investing. They won't invest in if you're not auto enrollment, you won't get the 0.5, will you?
If you're
not in auto enrollment, you won't get the government.
No, so the government uplift is only specific to auto enrolment. Private pension schemes, it's more to do with tax relief for the employee.
Yeah, that's okay.
And then a contribution from the employer. Yeah.
On that, Paul, it's important to consider as well, with auto enrolment, it's a 0.5% uplift, okay? Which a 20% taxpayer will probably benefit slightly more on it, okay? Because Nathan, correct me if I'm wrong, I think the benefit is, it's 25% as opposed to say 20% tax relief. There's one thing, from an employer's perspective that they need to be quite cognizant of, is that for 40% taxpayers, if with auto enrolment, it's still just a 25% uplift. Whereas with a 40% taxpayer, if they're paying into a group scheme with an employer, they'll actually get 40% tax relief on a contribution, as opposed to the 25% uplift. So, like, an employer is almost doing the 40% taxpayer an injustice by putting them into auto enrolment.
Yeah. So there's
the water's a little bit more for everybody.
No, but everybody knew this was coming, but now it's getting to the point, as we are Irish people, we lastminute.com, and we'll sort it out at this end of it when it really becomes necessary. But I think it's a step forward in terms of employee and in terms of getting people to start considering pensions. I think it's absolutely, it's the right thing to do, in terms of that. And I always engage, I cannot, how you invest your money and control of it means you get a good broker. But the tax relief side of it is really important in terms of taking the benefit of that as well and bringing your overall effective tax rate down. Would any of you have any other questions you'd like to say, or anything else you'd like to add to this?
I think just to add to the point, I think one of the positives of auto enrolment is that, my own opinion is that there's definitely inertia when it comes to pensions in Ireland, particularly with maybe the younger demographic. I do think auto enrolment will change that. It'll definitely get more and more people talking about pensions, getting a better understanding of how pensions work. So I do think that that's definitely one of the benefits of auto enrolment, is that I think it will increase pension coverage in Ireland. So I do think that is one of the benefits.
It's fantastic, really, because it is a topic now that people are asking, and like Nathan, you're dealing with brokers, whereas I'm dealing with the public as such, and like everyone is actually talking about pensions now, which is absolutely fantastic. When you look at the rate of the old age pension, like ultimately you're going, when you hit 66, you're gone from, be it 30, 40, 50,000, whatever your salary is, down to 15,000. And like, that's a big shock, and people I suppose historically have been putting pensions on the long finger and, I'll do it next year, and suddenly you hit 60 and maybe, it's never too late, but it's not simple then funding at that stage. A couple of questions I've got here, Nathan, they're just from employers when we have you on board as well. For contract workers, okay, employers, what's the situation there where you have contract workers in for 6 months?
It comes down to the salary, Kent, as long as they meet the criteria. Again, it's to do with the look back period, guys. So when they do the look back period in the payroll, if that individual is on course or has earned the equivalent salary, that they will be enrolled, So
I suppose they're like, this is where the dual scheme comes in, and where it can get complicated, because, like, say, if you have employers there who have a core of staff and they have their own group scheme in, but for different projects, they might bring in, for maybe 3-month projects, they might bring in contractors. It won't suit to put them into their existing group schemes. So ultimately, they join the AE just follows their PPSN number realistically.
Yeah, it's essentially what Auto Enrolment is. It's a pod follows member approach.
Yeah.
So it follows them, wherever they go.
Yeah.
It just sorry, Kent, go ahead.
Yeah, and just it is important because I'd see from the service we provide, and I'm sure every good broker out there does as well. People in their group schemes, it is your money, and it's nice to have a say in where it goes. Whereas maybe at Auto Enrolment you don't have that flexibility. Whereas by coming to an independent broker like ourselves and all the brokers out there, it's very important that you can actually sit down with somebody and discuss it. You alluded to it earlier, Nathan, where there's no advice here with the AE, whereas there is if you go down the private scheme route. But ultimately, that's up to the employers.
Yeah, I suppose a couple of comments on that to finish off. I've always seen that people who pay on a consistent basis into a fund, to get the cost averaging, invariably always end up with more money at the end of the scheme with the right investment choice. So, small, considered, continuous, the cumulative effect of that will actually absolutely outweigh. We encourage all people to really consider the pension, not just from a tax perspective, but from a family wealth building perspective, because people are living longer. Do you know what I mean? And that's the biggest thing. And that's the reason this whole thing came in, is the government witnessed that, people born today, can expect to live to 100. When you were born, Kent, people were expecting to live a lot less. You've been older. But, and the other thing I will say on that is, from our perspective, we do fully outsourced CFO service. We do payroll, bookkeeping, accounting, compliance. But our biggest department that we have is the payroll department, on a growth project, because this thing it's not simple to do payroll. People think it's, I'll just put the information in there. You would put the information in, but this is to do with an employee, and this is to do with their life. So you really need to consider payroll and responsibilities of a payroll department. So now we're happy to talk to anybody about this. It's not a sales pitch, but seriously, whoever your advisors are, make sure that you're dealing with payroll and HR and all of that necessarily at the right level. And this is another adding to the compliance as an employer that you have to do. But we're there, we can't do anything about it. And, Nathan, Kent and I have done a lot of these talks, but I genuinely want to say, Nathan, you just speak with this subject at ease. You know the subject really well. You know it inside out. Mm-hmm. And from my perspective and the clients and the people listening here, I genuinely want to say it's a pleasure to have you on. You're an expert in the subject, and thank you so much. And thank you as well, Kent.
No worries. Thank you.
Okay, and that's all for now. And we will send out a copy of this, or anyone want to reach out and get a copy of it. And we'll put another couple of little bits and pieces in with you, the contact details for Kent and that as well, the lads. Thank you.
Thank you.
Thanks, Paul. See you, Nathan.
Thanks, lads.